Hello, everyone. This is Dr. Kenneth Ta. Today, we are going to consider Chapter 2. Chapter 2 is on financial statements and cash flow. In Chapter 2, we are going to talk about the income statement, the balance sheet, the statement of cash flows. These are major financial statements that are developed by a corporation. We will talk about free cash flow and performance measures. The determinants of intrinsic value, the concept of free cash flow is very important in finance. Free cash flow is the cash flow that is available to pay investors, cash flow that is available for distribution to investors. So this is really how we calculate the intrinsic value of a company. We use the free cash flow that the company generates period after period. So for us to get free cash flow, it begins with sales revenue. Then we need to subtract the operating costs and taxes. We need to also subtract the required investment in operating capital, and that is going to generate free cash flow. In calculating the present value of free cash flow for every period, the interest rate or the rate that we use is the weighted average cost of capital. The weighted average cost of capital is computed using the proportion of debt and equity. So by equity, we mean common stock equity and preferred stock equity. So once we have the weighted average cost of capital, which is the WACC, we can use that in calculating the present value of free cash flow period after period. And then we sum them up. That will give us the value of the company, the intrinsic value of the company. So the value of a company is basically the present value of all free cash flow, the sum of present values of all free cash flow. If we look at this company, this is Computron Incorporated. We can see some information that we are going to use in this chapter. This company made a major expansion in 2019. As they moved from 2018 to 2019, there was a lot of investment that was done by the company to support their expansion. So what we find here are key information, and we are going to look at financial statements for the company so that we can evaluate this expansion. We see the stock price that is given in 2018. It was $50 per share. And in 2019, there was a drop in the market price, in the stock price, from $50 per share to $30 per share, which is not a good thing. So it seems the market was not quite happy with what was taking place in this company. But we'll come to do a more in-depth analysis. We also find the number of shares outstanding remain the same, basically 100 million. Dividend drop over the period. In 2018, the company made 90 million in dividends, and in 2019, it had dropped to 84 million. The tax rate for both years remained at 25%. The cost of capital for this company, which is the WACC, weighted average cost of capital, remains the same at 10%. All right, we'll introduce ourselves to the respective financial statements of this company, and then we are going to go a little bit in depth in calculating certain performance measure. So the first statement we want to talk about is the income statement. The income statement. The income statement basically reflects performance during the period. So we can see the income statement for this company for 2018 and 2019. So it begins with sales revenue, and then we have the cost of goods sold. The cost of goods sold include things like labor, raw materials, and other expenses that are directly related to the production or purchase of items or services sold in that period. So we have the cost of goods sold, we have depreciation, we have other expenses. So if we take cost of goods sold, depreciation, and other expenses, that is going to give us our total operating costs. And we take this total operating costs, we subtract from the sales. So sales minus total operating costs, that is going to give us our earnings before interest and taxes. Earnings before interest and taxes. Then we subtract interest expense. That will give us our pre-tax earning. We calculate 25% of this pre-tax earning because taxes is 25%, and that will give us our net income. So that is really the whole idea of the income statement. We are able to see the net income for that period. So the income statement reflects performance during the period. So we can see performance for this company for the year 2018 and the year 2019. And we can do some analysis just looking at this statement. For example, we can ask ourselves what happened to sales and net income, especially as the company moved from 2018 to 2019. So if we look at sales, we will see that sales increase by about 500 million. In 2018, sales was 5,500 million, so it's in millions. And then there was an increase by 500 million, which is about a 9% growth. That's a 9% growth in sales. But some other variables that can catch our attention quickly, we find that there is increase in interest payment. So if we look at interest expense, in 2018, it was at 68 million. It increased to 108 million. So that is a huge increase. In fact, about 59% increase in interest payment. And we come down to the net income. What we find is that the net income falls. 2018 net income was at 369 million. It falls to 264 million. That is a fall by 105 million. So that is what is going on in this company. So you can see how the income statement can inform us about the performance of this company. There is growth that is taking place. In fact, sales grow by about 9%. But at the same time, there is a huge increase in interest payment by about 59%. But what we find is that net income falls by 105 million. So that is what we are finding in this statement. Sales increase, increase in interest payment, and a decrease in net income. So that is the income statement. All right, the next statement we want to brace ourselves with is the balance sheet. The balance sheet. So again, companies will have the income statement, the balance sheet, and the statement of cash flow. So the balance sheet is a snapshot of a company's financial position on the last day of each year. So it gives us the company's financial position, a snapshot of the company's financial position as at December 31st, 2019 or 2018. So we find the balance sheet for the year 2018 and 2019. The balance sheet is structured in such a way that on the top part, we have the assets, and on the bottom, we have liabilities and equity. So we are going to analyze the asset. So these are assets. which are things the company owns. And they are usually listed in order of liquidity, which is the time it takes to convert the asset to cash, the order of liquidity. So it's the time, liquidity is the time it takes to convert the asset to cash. So in developing the balance sheet, again, we start with the assets. We start from the most liquid asset, which is cash itself. We have cash, then we have short-term investments, we have accounts receivable, we have inventories. So when we add all of this, this gives us what we call our current asset, the total current asset. So for the year 2019, total current asset is 1,400 million, 1,400 million. Then we need to subtract so we have total current asset, then we have the gross, sorry, we have the gross fixed asset. So we need to take fixed asset into consideration. So the aim is for us to get our net, our total asset. So our total asset is going to be current asset plus the net fixed asset. So we have current asset at 1,400 million. We have the gross fixed asset. Again, we are at 2019. So the gross fixed asset is 4,820,000. We subtract depreciation of 1,320,000. So that gives us our net asset of 3,500 million. So if we take our total current asset plus the fixed asset, that gives us our total asset. So for 2019, we find that total asset is at 4,900 million. So what is going on with total asset? We can see that there is a huge growth in total asset. In 2019, it was at 4,800 million. And then the company is experiencing a growth at 2019, is now at 4,900 million. We can look in depth. We find that current asset and net fixed asset each grew over the year. Current asset is growing, and the net fixed asset is also growing as well. We can go into current asset. We will find that accounts receivable and inventory almost double. So accounts receivable 2018 was at 400 million, 2019 at 520 million. Inventory was at 620 million, and then it increased significantly to 820 million. Cash and short-term investment falls. So cash and short-term investment falls. So this is some of the things that are driving total asset. Like what we find for this company is that total asset has increased as the company moved from 2018 to 2019. So this is the things we are discussing, the effect of the expansion on asset. So total asset, as we saw, have increased. Current asset and net fixed asset are growing. Account receivable and inventory has grown as well. Cash and short-term investment has fallen. So that is the asset side of the balance sheet. We are going to look at the bottom part of the balance sheet, which is the liabilities and equity. The liabilities and equity. So liabilities and equity are actually the claim that various groups have against the company's value. And it's usually listed in order in which they must be paid. So we have accounts payable. Accounts payable, a company buys supplies, but doesn't immediately make payment. So it is captured as account payable. Company buys supplies, but doesn't immediately make payment. So that is a liability, accounts payable. The next we find is notes payable. Notes payables are loans that must be repaid within the year. No loans that must be repaid within the year. Then we have accruals, which are amount owed. It could be wages accrued or rents accrued. So it could be wages owed or rents owed. So these are amounts that are owed. Then if we add all of that, accounts payable, notes payable, accruals, they give us our total current liability. Then we also have long-term debt, long-term debt. So long-term debt, they are claims held by someone other than stockholders, and it is for the long run. So we have long-term debt. If we take long-term debt plus current liability, that is going to give us our total liability. Once we have total liability, the next item that comes on the balance sheet, liability and equity side, is the common stock. And then we have the retained earnings. Retained earnings is the earnings not paid out as dividend to shareholders. It's retained by the company. So from total current asset, we add our common stock, we add our common stock plus retained earnings give us our total equity. So total equity plus our total liability is going to give us our total liability and equity, our total liability and equity. So this is the balance sheet. If we go back, you will discover that the assets and the total liabilities and equity, they come up to the same amount. Again, we had mentioned that the liabilities and equities are the claim that various groups have against the company's value. So if we go back, we see for 2019 that the total asset is 4,900 million. Then we go in front, we see that the total liability and equity for 2019 is 4,900 million. So the assets is equivalent to the liability plus the equity. So liability plus equity. Asset is equivalent to liability plus equity. All right, so we can analyze this liability and equity section of the balance sheet. So the key question we ask here is, what effect did the expansion have on the liability and the equity of the company? So we've already seen that there was a huge expansion in this company as the company moved from 2018 to 2019. What we are finding here is that debt is increasing. Debt is increasing, which means that the company is using debt to finance the expansion. We see in terms of total current liability, it has increased. Total current liability has increased significantly from 550 million to 890 million. Long-term debt has also increased significantly from 800 million to 1,100 million. So debt is increasing. The company is using debt to finance their expansion. And this makes sense because we will find that the company didn't issue any stock. They didn't issue any stock. So common stock remained the same, 1,000 million in 2018, 1,000 million in 2019. But retained earnings has increased. Retained earnings have increased. So the company is holding back from extending money that belongs to shareholders. So that is what we can find on the balance sheet. The balance sheet. All right, the next statement we want to look at. So this is what we just said about what is going on the liability and equity side. Debt has increased, but the company did not issue any stock. Retained earnings has increased. The other statement and the last that we want to look at is the statement of cash flow. So we have seen the balance sheet, which is a snapshot of the company's performance as at December 31st of a particular year. We have discussed the company's income statement, which was the first statement we look at. We said the income statement reflects the company's performance during a period. And now we want to look at the statement of cash flow. The statement of cash flow. The statement of cash flow separates a company's activities into three categories. It looks at cash flow that is generated from operating activities. A look at cash flow that is generated from investing activities, and then cash flow that is generated from financing activity. So let's look at the first, which is operating activities. Operating activities. So operating activities, we basically have the net income, which for the year 2019, the net income stands at 264 million. And then we make certain adjustments on the net income. So these are adjustments that are driven by changes in working capital, driven by changes in working capital. So that includes depreciation. Oh, we take out depreciation, then we make adjustments that are driven by changes in working capital, which includes changes in accounts receivable, changes in inventories, changes in accounts payable, and changes in accruals. So we can go to the statement behind and we'll be able to see these changes. Now they reflect on the statement of cash flow. So when we take the net income and we make adjustments, depreciation, and changes that are driven by working capital, that will give us the net cash flow by operating activity. So in this case, we have a positive cash flow from operations, positive cash flow from operations. All right, so still on the statement of cash flow, again, the first part is operating activities. The second part is going to be investing activities. So investing activities. What cash flow is being generated or used by investing activity? So we have cash flow to acquire fixed asset, cash flow to acquire fixed assets. So for 2019, it is negative 920 million. So a lot of money is going out to buy fixed asset. Then we need to take into consideration change in short-term investment. So change in short-term investment is 90 million. So that leaves us with a total of negative 830 million. So the net cash flow that is provided or used by investing activity is a negative 830 million. So it's a negative cash flow from investing activity. All right, the last part of the statement of cash flow is financing activity, cash flow from financing activity. So we have the change in notes payable, and then we also have the change in long-term debt, and we have the change and the payment of cash dividend. So the change in notes payable plus the change in long-term debt minus the payment of cash dividend. That will leave us with the net cash provided or used by financing activity. So we have a net cash flow from financing activity, which is positive, which is positive. So we can bring all those statements together, which that is usually done at the bottom of the statement of cash flow. So it's basically trying to understand the cash at the end of the year for the company, the cash at the end of the year. So we go to this next slide that will show us the summary. So we have the net cash provided or used by operating activity. Then we consider the net cash provided or used by investing activity, and then the net cash provided or used by financing activity. So all the totals from the three subsections that we just look at. So this gives us a net cash, a net change in cash of negative 10 million. And then we'll bring in the cash at the beginning of the year, the cash at the beginning of the year. This is the cash that was there at the end of the year 2018. So when we bring that, we see that we end up with cash at end of year 2019, which is going to be 50 million. So this is the cash at 50 million. If we go back to the balance sheet, we'll realize that this 50 million was there, is the cash that was recorded at the top of the balance sheet. So let me go that back and let's confirm that. So looking for the balance sheet. So this is the balance sheet, and this is the cash for 2019 at the top of the balance sheet, which is 50 million. All right. So we can just look at this and kind of make a quick comment. So what we are finding is that there is a positive net cash flow from operating activity, but there is a huge negative cash flow from investment activity. And we have a net cash flow from financing activity. And then even after the borrowing, we find that the cash flow tends to drop. So the cash flow falls. And we can see that clearly if we go back again to the financial statement where we have the 50 million cash. But notice, and that is for 2019, notice that in 2018, the cash was at 60 million. So there is a drop in cash flow. So even after the company has made a huge borrowing in the year 2019, there is a drop in cash flow. So this is what we are talking about, a positive net cash flow from operating activity. That is dragged down by a big net increase in working capital. We also saw a negative net cash flow from investing activity, which is small increases due to selling of short-term investment, and a bigger decrease to large fixed asset expenditure. Then we saw a net cash flow from financing activity that was driven by big increase in borrowings. And we said even after borrowing, the cash flow falls, as we see how the company's cash asset change in 2019 when we compare to the cash that was there at 2018. All right, so having introduced ourselves to the concept, the different financial statements, we have seen the income statement, we have seen the balance sheet, and we have seen the statement of cash flows and how we can just observe those different statements to understand what is going on. The next thing we want to do is to have an understanding of the free cash flow and why is it important, and be able to compute free cash flow. And then we will use both free cash flow and the components of free cash flow to do certain performance analysis. So free cash flow is the amount of cash that is available from operation for distribution to all investors after making the necessary investments to support future operation. So it's a very important concept. It's the cash that is available for distribution to investors, and that includes stockholders and bondholders. So we've also seen that free cash flow is important because it helps us to determine the company's value. So a company's value depends on the amount of free cash flow it can generate. So once we get the free cash flow of the company period after period, we can calculate the present value of each of those cash flows and sum them up. That will give us the value of the company, that intrinsic value of the company. All right, the next thing we want to ask ourselves is what are the uses of free cash flow? What are the uses of free cash flow? There are 5 uses of free cash flow. Once a company has free cash flow, what do they use it for? The company can use it to pay interest on debt. They can use it to pay back principals, to the principal on the debt. So it could be the payment of debt, whether it's interest or payment. They can use to pay dividend. They can use to buy back stocks, and they can use to buy non-operating assets. For example, marketable securities, investments in other companies. That's what companies generally will use free cash flow for. All right, now we want to see how we can look at the company's financial statements and calculate free cash flow. So it's quite hectic to do, but a calm mind, we can navigate our way to calculating free cash flow. So we can place this into 5 steps. Step 1, step 2, step 3, step 4, step 5. At the end of step 1, we are able to generate the net operating profit after taxes. It is basically the earnings before interest and taxes times 1 minus tax rate. Then step 2, we get the net operating working capital, which is the operating current asset minus the operating current liability. In step 3, we generate the total net operating capital, which is the net operating working capital plus the operating long-term assets. So once we add that up, we are able to get the total net operating capital. And then in step 4, we are able to, we generate what we call the net investment in operating capital. The net investment in operating capital is the total net operating capital this year minus the total net operating capital last year. All right, we have this net investment in operating capital. We use that with what was generated in step 1. In step 1, we had the net operating profit after taxes. We take that and we subtract the net investment in operating capital that comes from step 4. And that is how we compute the free cash flow for the company, the free cash flow. All right, we are going to look at this step by step. So the first thing we want to calculate, which is step 1, is the net operating profit after taxes, the net operating profit after taxes. So based on the formula I just shared in the diagram, That is equivalent to the earnings before interest and taxes times 1 minus taxes. The tax rate is 24%. If we go to the income statement for the year 2019, we will see that the earning before interest and taxes is 460 million, 460 million. So we take that times 1 minus 25, that gives us a net operating profit after taxes for the year 2019, which is equivalent to 345 million. And we can do the same for 2018. We have the net operating profit after taxes, which is equivalent to 420 million. All right, so as we move from 2018 to 2019, we can see that the net operating profit after taxes is dropping. All right, that is step one. We are on our way to calculating the free cash flow for this company we are analyzing. All right, step two is the calculation of the net operating working capital, the calculation of the net operating working capital. If we go back to that diagram, we realize that net operating working capital is equivalent to operating current asset minus operating current liabilities, current liabilities. So operating current assets are current assets that are needed to support operations. So they include things like cash, inventory, receivables, and they exclude items like short-term investments because these are not part of operation. All right, we can say a similar thing about operating current liabilities. They are current liabilities resulting as a normal part of operation. So it includes accounts payable and accruals and exclude line item like notes payable because this is a source of financing, not a part of operation. So with that in mind, the second step, we can calculate our net operating working capital, which we said it is operating current asset minus operating current liabilities. So our operating current asset again includes cash, it includes inventory, it includes receivable. So if we go to our statements, cash is for the year 2019, cash is 50 million plus inventory, which is 520 million plus receivables, which is 820 million. So we sum all of that, that will give us our operating current asset and then our operating current liabilities, accounts payable plus accruals. So if we go again to our financial statement, accounts payable is 400 million and accruals is 240 million. So when we take operating current asset minus operating current liability, that is going to give us our net operating working capital, which for the year 2019, it is going to be 750 million. If we do the same for 2018, we are going to have 580 million, 580 million. So we can see that as we move from 2018 to 2019, there is a drop in the net operating working capital for the company. So that is step two. Step three is for us to calculate the net operating capital, the net operating capital. The net operating capital is also called The total net operating capital, also called operating capital, is basically what we had in step 2. So in step 2, we had the net operating working capital. So we basically just take that and we add the net fixed asset. The net fixed asset, we are able to get that from the financial statements, precisely the balance sheet. So for the year 2019, we have a total net operating working capital of 4,250. For 2018, it were at 3,480. All right, that is step 3. We go to step 4. Step 4 is basically this first part, this second part here, which is the net investment in operating activity. And then step 5 is going to be the free cash flow, which is equivalent to the free cash flow, which is equivalent to the net operating profit after taxes that was generated in step 1 minus the net investment in operating capital, which is what we generate in step 4. So in step 4, it is the net investment in operating capital. If we go back to the diagram, that is going to be equivalent to the total net operating capital this year minus the total net operating capital last year. So we just need to go a statement back and we'll find that is 4,225 million minus 3,480 million. So step 4, we end up with 770 million, 774 million. So if we go back, our step 4 is basically this total net operating capital for the current year minus the total net operating capital for the previous year. And that gives us 770 million. And then the last step is the calculation of free cash flow, which is going to be, again, what we obtain in step 1, which is the net operating profit after taxes minus the net investment in operating capital. And once we do that, 345 million minus 770 million, we have a negative free cash flow of 425 million. A negative free cash flow, a negative free cash flow. So we can step back and ask a question. What do you suppose will be investors' reaction? So for investors to hear that the company ended up with a negative free cash flow, what would be their reaction? Negative free cash flow is not necessarily bad. The first instinct is to say this is horrible because just from the definition of free cash flow, which is the amount of money that is available for distribution to investors, a negative free cash flow doesn't send the right signal. But we can argue that it's not necessarily bad because free cash flow comes from net operating profit after taxes and net investment in operating activity. So there are these two things that are driving the free cash flow. So if it is because the net operating profit after taxes is negative, because if this is negative, it's going to affect free cash flow. If it is negative, then that is bad because it suggests operating problems. But a negative free cash flow can be okay, could be okay, if it is because net investment in operating capital is high. And we expect this to be high if the company is trying to support growth. They are trying to support growth, then the net investment in operating capital could go up. So if that is what is suppressing, if it is that and that only that is suppressing free cash flow, then it might not be a problem if we have a negative free cash flow. But the company with a negative free cash flow that is as a result of a negative net operating profit after taxes is bad because it suggests operating problems. It suggests operating problems. So we have come to a place where we are able to calculate free cash flow, which is great. We can basically use the steps and we go into the financial statement. We lift up the line items that are needed and we'll be able to arrive at free cash flow. Remember, we had talked about the five good uses of free cash flow, which is basically to pay off interest payment, the reduction of debt, payment of dividend, repurchase of stocks, purchase of short-term security investments. So if we look at it from that direction, it confirms the negative free cash flow we had of 425 million. All right. So the next assignment we have is to look at some performance evaluation measures, And in this chapter, we are going to use the free cash flow and its components to measure a company's performance. So there are three important performance measures that we are going to calculate. The first one is what we call the return on invested capital. The second one is the market value added. And the third is what we call the economic value added. Again, in calculating these performance measures, we are going to use the components of free cash flow, the components of free cash flow. All right, we are going to begin with the first, which is return on investment or invested capital. For us to understand this, we need to calculate what we call the operating profitability, and then we calculate capital utilization, because these two things drive a return on invested capital, and they are going to help us to interpret whatever we are getting as a return on invested capital. All right. So let's begin with operating profitability. Operating profitability. The formula for calculating operating profitability is basically net operating profit after taxes, which we have seen. Again, most of these variables we have seen in the computation of free cash flow. So we will take that and divide it by sales. We will take that and divide it by sales. So just from this operating profitability actually tells us the percentage of operating profit per dollar of sales, per dollar of sales. The amount of operating profit generated by a dollar sales. So we take net operating profit after taxes and divide by sale. So for 2019, we had computed net operating profit after taxes in our calculation of the free cash flow. We're at 345 million. We divide that by sales, so we end up with operating profit of 5.8%. If we do the same for 2018, the operating profit is at 7%. So what we find here is that operating profit is dropping. So the operating profit, which is the amount of operating profit generated by a dollar of sale, falls as the company moved from 2018 to 2019. All right, the second thing we want to calculate is capital requirement or capital utilization. So these two things will inform us in our interpretation of return on invested capital, which is one of three performance measures that we want to calculate in this chapter. All right, so capital requirement, or what we call capital utilization. This is basically how much operating capital is tied up in generating a dollar sale. Is how much operating capital is tied up in generating a dollar of sales, or the amount of operating capital required to generate a dollar of sales. So it is basically total operating capital divided by sales. And if we go back in one of the items of free cash flow, we calculated the total operating capital for the year 2019, which is 4,250 divided by sales, which is 6,000 million. That gives us a capital requirement of 70.8%. And for 2018, it is 58%. So what we find is that capital requirement is increasing as the company moves from 2018 to 2019. So it went up, which means that capital utilization worsened. As the company moved from 2018 to 2019, the utilization of capital worsened. All right, now we can go to the first performance measure that we want to calculate. And both this capital utilization and operating profitability, as I mentioned, will help us in the interpretation of the first measure, which is the return on invested capital. So that is the first performance measure we want to calculate, the return on invested capital, the return on invested capital. The return on invested capital shows how much net operating profit after tax is generated by each dollar of operating capital. It shows how much the net operating profit after tax is generated by each dollar of operating capital. So we basically just take the net operating profit after taxes divided by the total operating capital. Again, we have all of this when we're calculating free cash flow. So for 2019, the return on invested capital is 8.1. For 2018, the return on invested capital is 12.1. So what we find is that return on invested capital falls. It falls. Why? We can see why when we look at those two measures that explain return on invested capital. And the two measures we spoke about were operating profitability and capital utilization or capital requirement. So what we find is that this fall in return on invested capital as the company moves from 2018 to 2019 is because of a decline in operating profitability. We saw that operating profitability drops, and it's also as a result of increase in the operating capital required to generate a dollar of sales. So we had seen that capital requirement ratio increase, which means that capital utilization worsen. So that is what is driving down return on invested capital for the company. So that's the first performance measure that we have calculated. Again, return on invested capital, and we see a huge drop. Return on invested capital, which we said it shows how much net operating profit after taxes is generated by each dollar of operating capital. So there is a serious drop. All right. We can also interpret the return on invested capital in comparison with the WACC, which is the weighted average cost of capital. The firm cost of capital, let's say is 10%, giving us 10%. Did the growth add value? So that is the question we are asking ourselves. So the company was making huge investment in growth, buying asset. Did that growth add value? The answer is no, because the return on uh, invested capital, the return on invested capital is 8.1%, which is less than the weighted average cost of capital of 10%. So investors did not get a return they require. For investors to get a return they require, they need to get a high return on invested capital. So the weighted average cost of capital for this company is 10%. So in other words, it costs the company 10% to get capital. And when that capital is invested, the return on invested capital should be greater than the cost of capital for investors to be happy. But what we find here is that the return on invested capital is just 8.1%. So you can see it like this. A company borrows money and they need to pay 10%. That is the cost of capital. When they borrow money, they get capital. So they need to pay 10%. The cost of capital is 10%. They invest that money in a project. It is a good investment if the return on invested capital is greater than the cost of capital. So they'll expect something greater than 10% for the company to be happy. But what the company is getting is 8.1%. So it's a huge loss for investors. So we can note that the high growth that has caused a negative free cash flow due to investment is in capital is not okay. It's only okay if the return on invested capital is greater than the weighted average cost of capital. In this case, it's not the case for this company. All right. So that is the first performance measure. The second performance measure we want to compute is what we call the economic value added. The economic value added. This is also a very important measure. The economic value added, EVA, it represents the residual income that remains after the cost of all capital, including equity capital, has been deducted. It measures the extent to which the company has increased shareholders' value, economic value added, the extent to which the company has increased shareholders' value. So we need the weighted average cost of capital to calculate economic value added. It is basically the net operating profit after taxes minus the weighted average cost of capital times operating capital, So we have the measure of operating capital before, which is 4,250 million. The WACC, weighted average cost of capital, is given as 10%. So we bring it in this formula, which is 0.1. And then we have the net operating profit after taxes, which is 355. So that gives us a negative economic value added, a negative economic value added for the current year. The past year was positive. So the negative economic value added implies that the company is losing value. So the company lose value. And straight front, we can conclude that this is due to erosion in its operating performance. Because operating performance is dropping significantly, the company lose value. So the previous year economic operating performance was at 420 million. The current year is at 345 million. So this operating performance is dropping, and as a result of that, the economic value added is negative, which means that the company lost value. All right, the last performance measure that we want to calculate is the market value added, the market value added. The market value added is the difference between the market value of the firm's stock and the cumulative amount of equity capital that has been supplied by shareholders. The market value added, the difference between the market value of the firm's stock and the cumulative amount of equity capital that was supplied by shareholders. So market value added is equivalent to the market value of the firm minus the book value of the firm. The market value of the firm is basically the number of shares times price, market price, plus the market value of debt, the market value of debt. And then the book value is equivalent to the total equity plus debt, total equity plus debt. All right. So we have seen the economic value added. Now we want to look at the market value added. So the economic value added, it is typically used to evaluate management performance that is used for incentive compensation because it captures the value that was added for a given year, for a particular year. The market value added, on the other hand, it reflects performance over the company's entire life. Performance over the company's entire life. So one economic value added is performance for a particular period. The year that we are looking at, economic value added is over the company's life. That is why economic value added is used as a measure for incentive compensation rather than the market value added. All right, so we are on the market value added. If the market value of debt is close to the book value of debt, then the market value added is going to be the market value of equity minus the book value of equity. So the market value of equity, we already said, is the number of shares times the price, which we have 100 shares at $30 per share. That leaves us with 3,000 million. That is the market value. Then the book value of equity is basically the total equity, and we can get this from the balance sheet. So if we go to the balance sheet and we look at the total common equity, that gives us the book value of equity. So we can now calculate the market value added for 2019, which is that market value of equity minus the book value of equity. And that gives us 19 million. And also for 2018, the book value added was huge, 2,270 million. So there is a huge drop in market value added. So those are the three performance measure. So in this chapter, our assignment is basically to understand the three major financial statements, which is the income statement. It shows the performance of the company for a particular year or particular period of time. And then to understand the balance sheet, which is a snapshot of the company as at December 31st of a particular year. It shows us the assets and the liabilities and stockholders' equity. Asset is always equivalent to liabilities plus stockholders' equity. Then we have the statement of cash flow. The statement of cash flow is divided into three parts. It shows us cash flow from operating activity, cash flow from investing activity, cash flow from financing activity. So once we understand the three major financial statements, we go to the key concept, which is the free cash flow, which is the amount that is available for distribution to all investors. We see how we calculate the free cash flows of the company. And then we now need to do performance evaluation. And we use the components of free cash flow in calculating the performance evaluation of the company. And we have seen three performance measures. We have seen the return on invested capital and how to calculate that particular measure, how to calculate the market value added, and how to calculate the economic value added. So that brings us to the end of chapter 2.